All right, let's jump right into it. Today, we're digging into the latest earnings call from HealthEquity, the big player in the health savings account space. We're going to unpack the numbers, see what management's thinking, and figure out, is this the start of a real comeback for the stock?
It wasn't too long ago that HealthEquity was seriously in the penalty box with investors. I mean, they took a massive hit from fraud costs earlier in the year, and the stock just cratered. So the big question coming into this quarter was pretty simple. Did management finally get a handle on this problem? Is this the turnaround everyone's been waiting for? Okay, so let's kick things off with the headline numbers. Now, the after-hours reaction was, well, it was positive, but kind of modest, right? It felt like the market liked what it saw, but maybe wasn't quite ready to pop the champagne. So let's see exactly what they reported. First up, the big one, non-GAAP earnings per share. It came in at $1.01. Now, this is the number that really matters, right? It strips out all the noise and gives you a clean look at core profitability. And believe me, analysts watch this one like a hawk. And get this, that $1.01 figure, that was an 11% beat over what Wall Street was expecting. So let's be super clear here. On the bottom line, the company didn't just squeak by. They absolutely blew past expectations. Okay, so this is where it gets really interesting. You're probably asking, where did that beat come from? Well, it came from margins. Management delivered a record 44% adjusted EBITDA margin. I mean, that's a 500 basis point jump from last year. We're not talking about a small tweak here. This is a giant leap forward in how efficiently they're running the business. So if you look at the whole picture here, you can see how it all fits together. Yeah, revenue was up a solid 7% year over year, pretty much what everyone expected. But the real story, the thing that's changing the entire narrative around this company, is that monster earnings bait and those incredible margins. That's the takeaway.
So the big question is, how'd they do it? I can tell you right now, this wasn't just a lucky break. Nope, this was all about a very deliberate strategic shift. It was about them finally moving from playing defense to getting back on offense. And this slide just lays it out perfectly. I mean, think back a few quarters. The whole conversation was about that nearly $17 million hit to gross profit from fraud. It absolutely crushed their margins. And this quarter, fraud costs were just $300,000, a tiny fraction of what they were planning for. It is quite literally a night and day difference. So how did they make that happen? It was all about taking action. Management went all in on better security, things like passkey tech. They started using AI to make customer service way more efficient, and they got back to basics, focusing on the core strengths of the HSA business. And now, well, those investments are clearly paying off. They've proved they can do both, have industry-leading security, and a fantastic, efficient experience for their members. All right, so with the fire put out, management is now looking ahead. They laid out a super clear plan for what's next, and they even raised their guidance for the full year. That's a huge signal of confidence, telling everyone they think this momentum is here to stay. Their whole strategy really boils down to three key things. First, they're launching new platforms. One is to tackle the explosion in costs for those GLP-1 weight loss drugs, super timely. Another is for signing people up for HSAs directly. Second, they're going deeper on AI with a company called Parlo to really streamline member support. And third, they're going to keep doing what they do best, growing by picking up HSA portfolios. And really, CEO Scott Cutler summed it all up with this quote. He basically said, look, we're right in the middle of a huge affordability crisis in healthcare for families and companies. So their whole mission, their whole business, is positioned as the solution. By making the HSA a critical tool to fight those rising costs, they're tapping into a massive and frankly growing need. It's a powerful position to be in. And here it is, the proof in the pudding. This is what we in the business call a beat and raise. It's one thing to have a good quarter, but it's another thing to immediately raise your forecast for the entire year. They bumped up their guidance for revenue, for earnings, for EBITDA, everything. That's management telling the market loud and clear, this isn't a fluke, this is the new normal for us. Okay, so let's put it all together. What does all this mean for the stock from here on out? It's time for our final take, the rating and the prediction. First, just so we're all on the same page, what do we mean by outperform? Simple. We expect the stock to do better than the broader market, say the S&P 500, over the next 12 months. So here it is. Our official rating on HealthEquity is outperform. Look, after a period where there was a ton of doubt, what they pulled off this quarter was a huge de-risking event for the stock. So why are we so bullish?
Well, a few key reasons. 1, that margin expansion looks like it's here to stay. 2, the efficiency gains they're getting from AI, they're just getting started. 3, they've proven they have the fraud costs under control. That's huge. 4, they're rolling into their busiest time of year, onboarding season, with a full head of steam. And finally, number 5, they've smartly hedged against falling interest rates, which protects a big chunk of their revenue. It's a really solid setup.
And here's our prediction. That little 2 or 3% pop the stock got after hours, we think that's just the appetizer. As the rest of the market really starts to digest this new, much improved margin story and realizes that the whole fraud nightmare is in the rearview mirror, we think this stock has a lot of room to run. The turnaround story is legit, and we just don't think it's fully priced in. Yet.
And of course, we have to say it, this has been our take on the earnings call. It's all for informational purposes, and it is definitely not financial advice. Please do your own homework.